Hello and welcome to the Beyond Biotech podcast number 124. I'm Jim Cornell and this is the weekly podcast from Labiotech. This week we're talking about capital. SoftBank Vision Fund is one of the largest venture funds in the world, with more than $160 billion assets under management and a portfolio of more than 250 companies. So, definitely a good company to be talking to about macro investment trends within life sciences, the European health and biotech scene, as well as the precise applications of new and emerging AI technologies. Our guest this week is John Cassidy. Hi John, thanks for joining us today.
Nice to speak to you today. John Cassidy, I'm Head of Life Sciences at the SoftBank Vision Fund. Vision Fund is two large growth equity venture capital funds focused on tech, 100 billion AUM in the first fund, 60 billion in the second fund. We're focused on investing in high innovation, high growth, private technology companies. My team specifically focused on investing in companies innovating at the intersection between technology and human health. And so we cover everything from therapeutics and biotech through to tools, diagnostics, digital health, and some high-tech medtech as well. SoftBank at the corporate level at the top co, has long held a view that we should be thinking about decades, if not longer, into the future and the impact that technologies we support can have. It's a reflection of that vision behind our investments and how we want to change, in my case, human healthcare for the better.
The pity that politics didn't have a vision beyond 3 or 4 years, because I think that's something that we need to evolve beyond as well.
I think timeline and alignment and incentives to deliver, against a timeline are extremely important. And I think you see that typically with private focused funds being kind of 10, 12-year funds. We're actually quite lucky that at Vision Fund 2, we're effectively an evergreen fund. So it's investing SoftBank Group balance sheet cash. And so in theory, quite patient capital because we don't have a fund life cycle to deliver back again. So can think a little bit longer term about the impact that our investments are making.
You do have quite a lot of companies in the portfolio. How do you manage so many, both from your company perspective and also from those in your own personal portfolio?
Yeah, we do have a large portfolio at the Vision Fund. We are divided into, focus teams. I lead the life sciences team. I have a life sciences background, PhD originally, and then a strategy consultant, and then a life sciences investor at another fund before moving over. I think we manage our portfolio quite actively. So our team spread over the US and Europe is able to look after the breadth of companies that we're working on, partly because we have such depth in our sector that we're able to get up to speed quicker and support those companies, through our ecosystem and network. Anyway, there's a lot of overlap actually in what a lot of our companies are doing, or at least complementarity. It is a lot of work. I'm not going to say that it's not, but I think it's quite manageable when you have a very focused, specialized team who are living and breathing this space day in, day out. We can spend more of our time actually looking for good deals, helping the companies that we've already invested in, rather than just learning about a new space, right? We're already fluent in the underlying content, and then it's, just looking for those unique situations which we think are attractive enough and can form a view relatively quickly. So although our headcount to sort of AUM, our assets under management, is pretty lean, it forces you to be very efficient.
Could you tell us a bit about some of the companies that you're working with?
Yeah, sure. I'd love to talk about a couple that we've invested this year and then a few that have been in our portfolio a little longer. The most recent deal that we announced, we've actually already invested in 2 rounds for, which is a company called Metsera, which is a New York-based biotech that is working on novel therapeutics for weight loss and metabolic disease. This is a company that we had known various parts of the organization for quite a while. They had acquired some assets from a spin out of Imperial College London that we had known before, and also some of the founders were known to our team through prior roles. This is an example of a very I guess, a very high caliber team and leadership team who we knew could execute really well with assets at the exact right stage of development, going into the clinic in an area we know is very hot and has a potential to create a lot of value, weight loss, and having all of the right ingredients of being in the right place in the right time. So they've raised their Series A this year, but also their Series B a couple of weeks ago, which we supported as well, and seem to be on a very good trajectory. I think the underlying thing there is, we really believe in the differentiation of their assets, even as the field gets more crowded. There is room for differentiation, and we're seeing that already in their clinical data. So we're pretty happy with how that company's going. Another one that we announced earlier in the year is SoftBank made a significant investment in a company called Tempus AI, which has since gone public and is a publicly traded company. We're not on the board there, but still remain close to them. And that's a company that's using next generation sequencing as the sort of base assay to support cancer patients and to unlock insights into their cancers and what that might mean for their treatment and their prognosis. But then going further than just providing that as raw data and actually collecting that data, combining it with all of the other clinical data that those patients have, in their electronic health records, their imaging data, radiology, their pathology data, everything, and cleaning that up and producing, really high quality patient data records. And then those can be used for research and to support better insights into, how those patients may be managed and how they may progress. There's a couple of different interesting things in there because one, you're providing a better service back to the physician and enabling them to look after their patients in a more informed way. And two, you're generating a data set that unlocks, the training of AI, ML models and algorithms that can see things that, individual physicians would struggle to see. And it's real world data as well. So it's not collected under the artificial constraints of a clinical trial. And then finally, because you have this curated data set, you can sell that to pharmaceutical companies who are looking for really interesting and deep, rich clinical data sets to do either finding novel targets and drug discovery or for understanding, how to develop existing drugs, what they might look like in a, clinical trial. You can effectively run a kind of virtual arm of a study to help inform how you design that study and design the statistics for it. So we think it's a really interesting moment. You couldn't have done this 10 years ago. I think it would have been very, very expensive to generate that data. There wouldn't have been enough of it for you to do anything really, really useful with in terms of training models and algorithms. But we've now got to the point where they're at scale. And we have the combination of all of these other types of data and knowing how to handle them and how to integrate it all into kind of one model. That's actually quite powerful. And so we like to see these situations where scale gives you an advantage. And these things are at that point where further investment will really unlock, a lot more insights, a lot more value from those data sets. There's another one that we invested in the summer. We're also quite interested in the application of AI ML on the actual discovery side of things. And so, quite a few of our companies in our portfolio have some kind of computational platform for either discovering new targets to go after with therapeutics or making better molecules, making better drugs, either by, learning from other drugs that already exist or breaking down some element of drug discovery into a process that is amenable to AI ML. So, for example, one of the companies we're invested in is called Ventus Therapeutics and has a combination of a biophysical model of molecular dynamics plus solvation water interacting with targets. And so able to take a protein structure and apply AI ML methods to virtually discover chemicals that will bind to that target. And so much better hit rate, much better molecules that you're generating, and also more diverse chemistry. So exploring a wider range of potential drugs and therefore less likelihood of falling down on a specific idiosyncratic issue, like a particular scaffold, a chemical backbone being toxic. If you have a diverse range of starting points, you have kind of other options that you can go with. And so that's a company that's now, done that at the discovery stage and taken drugs actually into the clinic for immunology and neurology diseases. And, I think that progress comes at a pretty interesting time for the field where people are watching and waiting to see how AI ML enabled biotechs are going to fare. And actually, the reality is that these tools haven't been used systematically for long enough to get any kind of real statistics on how these programs will do relative to kind of traditional programs. But I think what we do see is, some of these early programs kind of going into phase 1, going into phase 2 and having very positive momentum and progress and seeing that they performing very well compared to, other therapeutic programs. And so I think as an investor, we are quite excited about, that second and third generation of AI ML enabled drug discovery and drug development companies and how they're going to be able to systematize or I guess, make better repeatable improvements to the way that we develop and find these drugs.
At the very beginning of the process, what criteria do you tend to use when deciding upon investment into companies?
We're typically a later stage investor in the sense that we wouldn't do company formation ourselves or seed Series A typically, unless they're kind of really taking existing platforms and programs from somewhere else and just putting it into a new entity, which is actually more mature than the round suggests. We're typically coming in Series B, Series C and onwards. Our investment ticket size is $25 to $75 million for most new investments across those different categories that we cover. And on the therapeutic side, we're really looking for the combination of a platform that we believe has a differentiation and the ability to generate multiple programs that are interesting. And that platform is generally technology enabled, which often means computational in some level, or at least driven by interesting data sets generated at scale. And then the assets themselves, the drugs themselves, need to be approaching the clinic and certainly would expect our investment to fund the clinical trials that will show whether one or more of those drugs are really competitive. So we're looking at generating that phase 1B, phase 2 data, depending on what the disease is and what the drug modality is, but looking for things like biomarkers that are predictive of translational value or clinical efficacy in a number of patients. So that means we're normally coming into companies that are less than 12 months to IND, clearing the regulatory hurdle to get into patients or humans. On the other side of the fence, so on the tools, diagnostics, high-tech, med-tech, digital health, on those investments, we're typically looking for them to already be commercial stage and seeking growth capital. So normally they have, call it $10 million of revenue plus, and looking to grow that. So have found some level of product market fit and then looking for investors who can help take them, say, from $10 million to $100 million of revenue.
I guess over the last couple of years, we've heard about biotech companies and some biopharma companies having issues with funding. I just wondered how you see that and if there are any trends and whether it's getting better.
Yeah, the last couple of years have been tough, not just for life sciences. I think it's all high innovation sectors and, indeed most sectors globally. I think biotech is particularly sensitive given the cash flows are long dated, so very far into the future. And so things like interest rates going up, has a disproportionate impact on the valuation of those companies. And as that impacts the public markets, that tends to feed through pretty quickly to how people feel about private companies in the sector and, the confidence of an IPO being an option down the line, but also what valuation you're going to be able to continue to finance these, inherently cash burning companies. While there's been a challenging period, we've been fortunate that most of our portfolio was sufficiently capitalized to get through kind of 22, 23 without needing to raise capital under distressed circumstances. I think 2024 has been an interesting year because a lot of companies have, they typically raise 3 years runway back in 21 and so have come up for air this year. And it's been interesting to see what this market has been like today. I think you kind of break them down into three categories. There's the companies that are doing so well that they can raise, and they can raise at a valuation that's reasonable and looks good and we're happy with. And, investors in general, on those cap tables will be pleased with. You've got the companies that are performing reasonably well against their plan, but the particular subsector that they're in, whether it's cell and gene therapy or, other areas that have been maybe hit harder, they probably do need to reset sometimes, their valuation expectations to ensure that they get funded, but they'll still get funded. And then there are those who struggle to get funded because maybe the idea itself and the program, the drug, the platform, the risk reward is now, skewed slightly on the wrong side in the new environment. And those are the more difficult situations. And I think what we've seen over the last couple of years is, quite a few things fell into that bucket and have either merged with other things or wrapped up, while the other two buckets have been kind of fine or thriving. I think going into 2025 is very hard to call. I would have said the last couple of months prior to the last couple of weeks, the last couple of months were looking better and better. A few IPOs getting out, a few situations which I think gave people reasons to believe, some bolt-on M&A above $1 billion kind of exits. I think the election volatility has been a bit confusing to know exactly what it means. And I would say everything is relative. Compared to 2 years ago, we feel much better. Compared to maybe a month ago, we feel worse. Compared to a year ago, we're about the same. It's interesting to see how it changes quite quickly. I think our view being, as I said at the beginning, a longer term investor is that actually today represents a really nice opportunity to invest in high quality innovation at a valuation that's much more reasonable compared to 2020 and 2021. And I think if your time horizon is 10 years plus, the month to month volatility is less important than the sort of creation of value over a 5 to 10 year period.
You mentioned the election. I wonder, did that affect anything? Because it seemed like in some ways there were maybe mixed messages, because seems as if it's something that will be very pro big business. But then on the other hand, you're seeing quotes about controlling big pharma. So has that sent mixed messages out, or is it too early to say yet?
It is difficult. I think the one thing that nobody likes is uncertainty. And there was uncertainty in the run up to the election. It was perceived to be very, very too close to call. And the risk there is obviously that you get to a grey result where there's not universal kind of acceptance of that result. I think the fact that we had a very clear result that did lead to a little bump on the public side in biotech, when Trump got in. And I think it's equally about there being certainty of result as it is anything else. I think the stuff that comes afterwards, as you get more and more information about cabinet and policy, that's where the uncertainty is now. I think you saw that when RFK got announced and the impact on biotech stocks was pretty clear, negative and immediate. And I think a lot of that is uncertainty again. People don't know exactly how people are going to operate, what they think is within their remit, what they're actually able to do, over what time frame that might happen, whether there will be, confirmation through the Senate. All of those kinds of questions are kind of open questions, and that uncertainty, hangs, I think. I think it is a bit too early to say. Next year, putting that to one side, we have a lot of ingredients that are positive for growth. And so my hope is that we get some clarity on these things, and they're almost never, maybe I'll regret saying that, but things are almost never as bad as you imagine the worst case scenario could be. And they're almost never as good as you imagine the best scenario could be. So, we're likely to have a lot of compromises somewhere in the middle on some of these things. And if that's the case, then I think we're actually probably on a reasonable track.
Earlier, you mentioned about those three kinds of companies in terms of financing. What can companies do? Obviously, if you're in that top bucket, then you're fine. But what can companies do to move from, say, 2 to 1 or 3 to 2?
Yeah, I think the key drivers of what puts something on the right side of the risk reward is how much capital you need to get to a value creating readout. How thrifty are you? How cheaply can you deliver data? How quickly can you deliver that data? And how concrete is that data? You can't obviously control, that you're always going to have good data, but you can control whether the data will be equivocal or not. So making sure that things are designed in a way that you answer the question you set out to, and you deliver the data as quickly as possible for as little money as possible. We are in a sector where people do take risk for a living. Investing in biotech is inherently risky. People know that over 95% of things that make it to IND will never be approved. I mean, much closer to 99% of things. And so we're inherently willing to take that risk, but only if it's very clearly a kind of taking the risk on the specific drug in that disease, and not that you're going to mis-execute, and not that you're going to run over budget and run out of money, and all of these other things. So I think the things that people can control are delivering readouts quickly and very cleanly. I think there are some things that you just can't control. You have to commit to your program with high conviction, despite the fact that external interest in that disease area or that modality may come and go. That's why it's quite important that the investors you select in your early investment rounds are aligned and have that deep conviction that what you're working on is actually high value, even if the market changes its mind on what diseases are hot tomorrow. Ultimately, if you're curing patients or giving patients massive increase in quality of life or life expectancy, that is value being created. And whether you get credit for that value today or tomorrow is a question mark on how much value you get, but there is value. What you can't do is focus on things which are hot, but maybe of incremental value. Really minor improvements to existing therapeutics. In a hot market where everything's rising, you can probably get paid to do that. But when it's a tough financing environment like now, those kinds of things are the first ones that get hit.
Are there specific sectors or disease areas that are attracting more interest right now?
Absolutely. I mean, the pendulum swings frequently. I would say some of the things that are very interesting to a lot of people. I mean, weight loss and metabolism is an obvious one. It's just become a huge category overnight. It's obviously a challenging one as well, because there are a couple of companies, or two companies, who today are very dominant in that space, but there is huge opportunity. We obviously have seen that there's still quite a lot of opportunity to differentiate there, having made an investment this year in that space. I think an interesting, maybe not shift, but trend is that lots of diseases are today seen through a slightly different lens than they might have been in the past. And one of those lenses is through immunology. A lot of things are now perceived to have quite a significant component of immunology or inflammation in them. Everything from neuroscience, cancer, metabolic diseases, dermatology, obviously, a lot of these other areas actually intersect with immunology a lot. And so that's become very interesting for a lot of investors, not least because something that works may work in more than one disease and is not really limited to just that specific indication. And when people are hunting really attractive ROI, like return on investment, things where you could apply it in multiple different diseases tend to look pretty attractive. I think also just following the science, our understanding of certain diseases has just improved a lot over the last decade. I think neuroscience is a particularly interesting area, with things like the first approvals for disease-modifying Alzheimer's drugs, first approvals for ALS drugs. There's just been a lot more progress. And so people are more willing to take on diseases that we all know have huge economic and personal impact on patients. And so that's been quite exciting. And then across all of these different diseases, probably the theme that I guess we're maybe not most excited, but very excited about is just having a precision lens. So, you may have previously looked at a disease like, say, Parkinson's disease and viewed it as a single disease. But actually, the way that we like to look at things now is, much more precise way. Actually, that's a range of different patient phenotypes and genotypes in there. And actually, a one-size-fits-all drug is probably not going to be the right way. Everyone in the biotech community is very comfortable with viewing oncology that way. We have drugs that are approved for patients with a very specific mutation in the tumors. And we routinely genetically test those tumors and see what treatments a patient might be eligible that are very bespoke and personalized to them. I think doing the same thing in other disease areas is something that we're quite interested in. And for example, one of our portfolio companies, Neuron 23, has developed a companion diagnostic for their Parkinson's drug. And so they're finding patients based on a range of polymorphisms, SNPs, and finding patients who would be eligible and most likely to benefit from their Parkinson's drug, which is a LRRK2 inhibitor. That kind of approach in diseases which you've typically not thought of as being 10 different micro diseases, I think is a theme that we're seeing applied everywhere, because people want to increase probability of success, even if that reduces the population a little bit, which is, what happened in cancer, say 10, 15 years ago.
We hear a lot about treatments that cost in the millions per dose. How do you focus on the patients and the need as opposed to kind of those high-end treatments in terms of generating profits?
Yeah, I think ultimately what it comes down to is what I was saying before, which is you focus on creating value as the sort of North Star. Even thinking like, an HTA body like NICE or ICER, in the US, what is the cost benefit analysis that a payer system might apply to this, is on occasion entirely appropriate to pay a lot of money for an intervention if it saves a patient's life and saves the health system millions of dollars over the life of that patient. For example, rare neurodegenerative diseases in children, or things where the alternative is, repeat organ transplant and, high touch, I guess, in patient care for a patient. So I think the price of drugs and therapeutics that are being created has to be proportional to the benefit that you're getting from them. I think we do believe that there is still quite a lot of opportunity to deliver a lot of value, even at relatively low prices, and it has to track with prevalence to a degree, as you think about the impact on the healthcare system. But it's something we do think about a lot as we make new investments is, one, how much value are you creating for that patient and for the healthcare system? But two, what can the system actually afford to pay? And if we were ever in a position where, you're rolling out a gene therapy for a disease that has millions of patients and you're trying to treat all of them, then you kind of need structural changes in the system to either bring the cost of that down a lot or to find a way to make it bearable for the healthcare system. I think in general, where we have focused as a fund is on high acuity conditions, so high mortality or morbidity diseases, and therefore where the amount of value you can create for those patients is higher and therefore can tolerate higher pricing and hopefully be more immune from downward pressure on those innovative therapeutics coming to market.
You were talking earlier about the way that AI is impacting biotech companies and how they're using that. Do you use AI now to run through different scenarios with companies and to inform your decisions?
Yeah, it's a good question. I mean, AI is everywhere now. I think one of the interesting things is that, say, even 3 years ago, when we used to talk to people about AI in life sciences, it was not necessarily niche, but it was certainly perceived to be nascent. Whereas now, I would struggle to kind of name a company that we work with who doesn't somewhere use AI, even if they didn't develop it in-house. Even if it's just they are leveraging things like ChatGPT to help them with certain tasks and, certain procedures that they're running. And there's certainly a whole load of other, accessible applications, things like AlphaFold, things like NVIDIA's BioNeMo platform. A lot of people are using that even if they didn't make it themselves. It's just becoming part of the toolkit that is available to a lot of these life sciences companies. So similarly, we will lean on some of these things during our due diligence process, during our landscaping of the market, during some of our benchmarking, as we look to see what performance of a particular platform, what it can deliver. You need to benchmark it against, what's the state of the art. So yeah, we are adopting and using, more and more of these tools. I would say that the most interesting things are probably beyond our technical capability as individuals in the investment team, given that our day job is primarily understanding the science and business and finance of these companies. And so we work with, external advisors and consultants who can also help us stay abreast of the very latest on this stuff. But it's certainly quite a different environment than it was even just 3 years ago, given how quickly and explosively these things have taken off.
you can only assume that that's going to continue in the future. Clearly, it's evolving quickly and it will continue to do so, not just with biotech companies, but in general, I guess.
Yeah, I think that's right. I mean, the question is, at least in life sciences, I feel like the question is really what applications you focus on and where you spend a lot of time and money on what problems you try and solve with it. Because there is a temptation that you could try and just create like the theory of everything sort of thing. And that's intellectually very interesting and stimulating. But actually, the way that this industry is structured, the underlying insights and underlying capabilities are often not directly valued, right? In an M&A or, in a public life sciences company, what people actually value is what they let you do that you couldn't do before. And so I think what it does force people to do is become super sharp on what they actually want to focus on. Like, how do they use all of this toolkit? It's kind of the equivalent of being a builder who goes from using just, a hammer and a spade to all of a sudden you have every single, JCB digger and pneumatic drill and everything else you could possibly want. But at the end of the day, someone's going to buy a house from you. So you need to figure out how you don't just waste your time just digging loads of holes and playing around with new tools. At the end of the day, you need to build a better house as a result of it.
And I guess that you don't spend all of your money on all that equipment and you end up making £1 profit on the house, I guess.
Yeah, exactly. It all has to be proportionate. And that's why what problem you pick is so important. And coming back to your point about pricing of drugs, again, it needs to be not only did you pick a problem that was well suited to the tools, but you also picked a problem that created value for the healthcare system and therefore you can get paid for.
You mentioned earlier that you work with companies in different regions. Could you maybe give us a bit of a snapshot as to where European biotech is in comparison to other regions and whether there are any trends in that respect?
Yeah, so our team is split over North America and Europe in the life sciences team. Even though it's relatively evenly split, a lot of our dollars have been invested in the US. I think Europe, and this is not going to be particularly novel or insightful, but Europe has a lot of great science, has a lot of great innovation, fewer opportunities get to that later stage, high ambition, high vision, high growth setup in Europe than in the US. Part of it is there's less capital available at the earlier stages to be really bold. The size of the early stage rounds are definitely a lot smaller here, but it's also, I think, slightly cultural and slightly to do with access to talent. We have made multiple investments in Europe, and typically they have been, if you ask people in the local ecosystems, people would have said they were more American type companies, right? So they had management teams who had done it before. They had probably some US investors who had come in alongside and had raised, aspirational amounts of money, i.e. raised large rounds before they had delivered on everything that they would say they would do, but with the knowledge that actually to go after the plan that they had, they would need that capital up front to make the investment up front and to be able to pursue multiple things in parallel rather than focus on one thing. Once it succeeded, then allocate a little bit of money to the second thing. I think European biotech is well placed after this period of, valuations coming down, people being much more sensitive about capital efficiency. By definition, almost European companies have had to be more capital efficient in the past because they didn't raise as much money. And so actually, there's a lot of opportunity now for those same companies and same operators to go and deliver on very attractive business plans, delivering those clinical data quickly in a capital efficient way. We're actually already set up pretty well to do that. And I think this year has seen quite a few pretty reasonable biotech financings, above $100 million. There were a few last week, announced in Jefferies Week. And, I think we're going to see more of that. I think the other thing is there is more availability of capital here than there was in the past. And we are seeing it flow through to some companies being better capitalized from day one. It just takes time. This is like planting seeds, and then it takes a couple of years for them to grow kind of big enough for investors like us to take a look. And so that cohort that's being planted sort of over the last 12 months, that will be kind of 2025, 26, maybe even 27, that they become kind of companies that we could look at. And we stay close to those. We connect with these companies early, we connect with their investors early, and we try to share with them what our vision would be if we were in their shoes and help, I guess, shape maybe a bit more of an ambitious business plan so that, when we get there, they do have multiple programs that they're trying to take into the clinic, not just one. And they do have a platform that they've invested in, not given up on after they got their first program, out of it. It's on a good trajectory, but there's definitely still this divide that we see.
I guess we're getting to the end of 2024 now. Are there any things that you're looking forward to in 25, kind of the crystal ball thing? Are there any sort of landmarks for 25 that you're looking to, both in the sector and also financially?
Yeah, I mean, we sort of talked about earlier just how at the end of 24, we've just entered this period of maybe a lack of clarity or lack of, certainty on a few things. But I think broadly speaking, after 3 years, really, of the environment being tougher, I am hopeful that it's warming up for next year, that interest rates will continue to come down, even if it's a bit slower than we would like, and that you'll see a bit more pharma M&A, at a scale that returns capital to a lot of the ecosystem and makes people more likely to deploy more, that helps the LPs and all the funds get more excited about coming back. I think the IPO window will open next year. I think there's a question of when, but I believe it will open. And that unlocks quite a lot of value for a lot of people because, over the last couple of years, we've had a lot of good quality companies staying private and getting later and later stage and, delivering better and better data. And so actually when that window is open, the type of IPOs you'll be seeing will be very different to the type we saw, the last time the window was fully open, because last time it was very aspirational. It was, stories, potential, preclinical companies kind of telling a narrative that, sounded very attractive and kind of a lot of those milestones in the future. Whereas, a lot of the companies that are gearing up for IPOs now have actually delivered clinical data, have already got something tangible. I think a lot of potential for next year for this to be, a really important moment for these companies to get financed and for potentially some of that capital to be recycled into the ecosystem.
And what about from your own company's perspective? What are you looking forward to in 25?
So from our own company's perspectives, I mean, I think we've got similar themes, right? So a lot of those companies we would have expected at the time that when we invested in them, that they would have been public by now. And many of them that we came into when they were preclinical are now firmly in the clinic and running pretty innovative clinical trials with interesting and differentiated drugs. So I think some IPOs in our portfolio, I think would be a reasonable assumption if the window is open. Maybe some of them are more suited to pharma M&A if they have the right data set at the right point in time. We are quite excited about, ecosystem benefits. I think increased cooperation and collaboration, even between our portfolio companies, will continue. But I think overall, we feel pretty optimistic about 2025, certainly compared to how we felt, at the end of 2022 or the end of 2023. The end of 2024 feels like a more optimistic moment.
As 2024 draws to a close, a great overview of the life sciences scene, funding, and some potential trends for 2025. Don't forget to check out the latest news and articles over at Labiotech.eu, and I hope wherever in the world you are, you have a great week ahead. Thanks for listening, and I hope you'll join us again next time for another Beyond Biotech.